Welcome to Odisal Associates, Accounting and Finance Tutors. Today, we are going to look at interpretation of financial statements. Financial statement is very crucial in accounting. Everything about accounting is about financial statement. And in IFRS, we talk about general purpose financial statement. It comprises statement of profits or loss and other comprehensive income, statement of financial positions, statement of changes in equities, statement of cash flow, and notes to the account. Financial statement actually shows the status of an organization. However, it is not enough to determine whether an organization is a going concern or not until you go in deeper. Therefore, in order to understand the working of an organization, you must interpret the financial statement that has been given to you. This is the only way you are going to determine the health of the organization. It's a skill that stakeholders need to have in order to assess a company financial health and performance and prospects by applying various interpretation techniques, analyzing key performance indicators, and considering limitations and qualitative factors. Stakeholders can make informed decisions. There are different ways of interpreting financial statements. We have horizontal stroke trend analysis, vertical analysis, and ratio analysis. The horizontal stroke trend analysis compares financial statements data over a multiple period of time to identify trends and patterns. While vertical analysis examines each financial statement component as a percentage of a base figure, say total revenue or total assets. Ratio analysis calculates various ratios to evaluate a company's liquidity, solvency, profitability, and efficiency. These are ways that financial statement can be interpreted. Tools and resources for interpretation of financial statement. We have the financial statement analysis software, such as Excel, financial analysis tools, and others that facilitate the interpretation. And then we have industry reports and research studies. Insights from the industry and their annual statements, and all those are used to analyze financial ratios. Financial news and media. This is a very important resource in interpreting financial statements, as these come directly from the companies, the reporting entity. So it will be easier to use them. These are part of the resources and tools that are needed for financial interpretation, statement interpretation. Going forward, we're going to look at financial stroke accounting ratios. We could call it financial ratio or accounting ratio. We have key performance indicators of these ratios. They are profitability ratios, liquidity ratios, efficiency ratios, and solvency ratios. These are the basic names that these ratios are called. As we go on to study them, we will give you some of the names that they can also go by, so that when you hear them, you will not think that it's a different ratio. In these ratios, we have more than one ratios that can be computed from these ratios. In the profitability ratio, it determines the gross margin and net profits, showing the efficiency of management in their operation. Things like return on assets, return on equity, the ability of the management to generate profits is what a profitability ratio is all about. While liquidity ratio talks about current ratio, quick ratio, and cash ratio. And it's all about assessing the company's ability to meet up their short-term obligations as they fall due. A strong liquidity ratio ensures that the company is able to pay their debts when they fall due. And then efficiency ratios talks about the turnover ratio, ability to utilize assets of the company efficiently. So we look at turnover ratio, asset turnover ratio, inventory turnover ratio, account receivables and payable turnover ratios, and the collectibility of account receivable and the ability to pay accounts payable. So this is what efficiency ratio is all about. Then we have the solvency ratios, or what we call long-term solvency and stability ratio. This deals with the ability of the firm to meet their long-term obligations, and then how the company mixes their equity capital and debt, how the company is able to pay their interest, how many times their profit is able to cover their interest. So this is long-term solvency or stability ratios. Sources of data used for financial ratios. We have the financial statements. Of course, before now, I had already outlined the financial statement, which are statement of financial position, statement of profit or loss and other comprehensive income, statement of cash flows, statement of changes in equities, and notes to the accounts. These are basic areas, statements that you can get data in order to calculate your financial ratios. Then we have the annual reports of the company. The annual report of the company also assists us to gather some information, especially some information that may not be in the financial statement but disclosed in the account. It will also help us to know how the company is faring. Then we have regulatory filing. There are requirements, especially SEC and others, require some specific things that you must include in your financial statements. So when you look at regulatory filing, you'll be able to get some data that will help you to interpret financial statements. And then it's also here that you can get the price of the shares in the market value of shares, which may not be contained in the financial statement, but in the capital market pricing. And then we have some financial databases where you can also pull up data for calculating financial ratio. You can also go to company websites. The reporting entity's website in order to get some information. In fact, you can get the financial statement, the annual report from the company's website. And then for us to actually be able to calculate financial ratio, in this era of IFRS, we must master the accounting and financial reporting standards that is produced by ISB. It's very, very important that we read them. So these are sources of obtaining data to compute financial ratios to consider when analyzing financial ratios. These factors must be put into consideration at any point in time that you want to analyze a financial statement using financial. One is consistency. You must think about the method you are using and be consistent with it. And then your source of data should be genuine. You must ensure that you are getting your data from the right source. Because if you look at some data that somebody brings to you to analyze a particular situation, you find out that you have different data from different websites. So you must know the website that you are getting your data from so that the data you are getting will be the right data. And then the method you are using to analyze the data will be consistent. And again, the financial statement you are analyzing will also be consistent in the way it is presented from year to year. Because in doing ratio analysis, we try to uh, compare a company's performance along the years. So if the policies that was used to prepare the statements are not consistent, then it means that you may not be comparing the same thing. You might be comparing apple to orange. That is why it's important that you check the consistency of the method you are using. You check the consistency of the policies that were used to prepare the statement. And then you confirm that your data is from the right source. Comparability. Of course, we know very well that comparability is one of the things that plagues accounting. That's why we even go to IFRS. The ability to compare your account between industries, between previous year and current year is very, very important. Ratios are used to compare between companies in the same industry and outside uh, industries. We look at industry average, competitors, ratios, and benchmarks for us to be able to compare. Then we have trend analysis. Trend analysis. It's also a very important factor to consider. We compute ratio over times to identify trends and patterns. So in computing ratios, we must bear these three factors in mind. Expressing financial ratios. Financial ratios can be expressed using percentage, that is a percentage of something over something. Let's take, for instance, percentage of net profits over sales, percentage of gross profit over sales. It can also be expressed in time. For instance, we can say that the net profit of a company can cover the interest 3 times or 4 times. So the figure you get in computation of ratio can be expressed in time, like 2 times or so. It can also be expressed using days when we are calculating turnover, collectible period, collectability period, 5 days, 50 days, 20 days. We can also use proportion, like 3:1, like when we are doing current ratio. We say current asset is to current liability. So if this is current asset, this is current liability. What it means is that current asset covers current liabilities 3 times. 3:1. Then we have per share, per unit. When we express ratio in monetary term, let's take uh, something like earnings per shares. These are some ways of expressing ratios. Uses of financial ratios. Financial ratios are used to evaluate companies' health and prospects. Here we have different uses of financial ratio. One, performance evaluation. Two, benchmarking. Three, trend analysis. Four, credit worthiness. Five, investment decisions. Six, mergers and acquisitions. Seven, risk assessment. And eight, forecasting. These are not all the things we use ratio to do, but however, these are the ones that I've listed here. Of course, it is through ratio that we are able to evaluate the performance of our business, to know the profits and the loss, to know the percentage of our sales that we have made as profit, the gross profit and the net profit. Just having profit is not enough. But if we know the percentage of our sales that we are able to take as our own profit, then it will be easier for us to know how our business is doing, how much we are getting from what we have invested. Benchmarking. We have industry ratios where we compare company ratios with. We have competitors ratios where we compare our company ratios with. And we use this to evaluate the performance of our own company. Trend analysis. We compute ratios for different times, over times, and different years in order to trace patterns, trends, and potential pitfalls or problems. It is ratio that can help us do that. Credit worthiness. Through ratio, we'll be able to know whether a company can meet its short-term obligation. Not only short-term obligation, even long-term obligation as they fall due. When we'll be computing ratios, you will see the ratios that deal with short-term obligations and the ones that deal with long-term obligation. With computation of ratios, we'll be able to know whether the company can meet their obligations. Investment decisions. In fact, for investors, they do not have right to ask the companies to provide a particular financial statement for them. So they use the general purpose financial statement. And the general purpose financial statement is not enough for them to make decisions. So they have to go deeper by analyzing it using ratios to be able to make informed decisions whether they should invest or not invest. In forms of merger and acquisitions, which is also like investment decision making, we need ratios to know whether we should merge or whether we should acquire a firm or a company. Risk assessment. Through ratio, we're able to determine potential risks Of course, we know that risk is the probability that something can go wrong. When we say that there is a risk in something, it means that it is not foolproof that it's going to succeed. Something also might happen, and what we expected to get, we will not get. So through ratio, we can analyze and assess the risk inherent in a particular investment or in a company. Then forecasting, we can use ratio to forecast our revenue, to forecast our profit, to forecast the dividend that can be paid, to forecast the earnings that can be made. So these are uses of financial ratios. Thank you. Okay, guys, I think we have done well in this episode. A recap of what we have just done. We talked about mainly interpretation of financial statements, which I told you that there are different techniques of interpreting financial statements, such as the horizontal analysis, the vertical analysis, the trend analysis, and the financial ratio analysis, which we dealt so much on. And I told you that there are also some tools and resources, such as annual reports and industrial reports. We learned that there are key performance indicators of financial ratios. This is just talking about categories of ratios like the liquidity ratio, the profitability ratio, the long-term solvency and stability ratio, and the efficiency or activity ratios. We learned that there are sources that we can get data for our ratio computation, which include the financial statements, all the financial statements, includes the annual reports of companies, and so on. We also learned that there are factors that we consider when analyzing ratios, such as consistency and comparability. These are very, very important. And we talked about the way ratios are expressed. We say ratio can be expressed in percentages, can be expressed in time, can be expressed in proportion, and per share or per unit. And then we told you about different uses of financial ratio, which basically we talk about performance of companies, evaluating investment opportunities and decisions. These are the things that we have discussed in this episode. Thank you for watching. Please do not fail to hit the subscribe button and share. Watch out for the next episode.